to Behavioral Finance and FinTech. Today we're going to cover overconfident CEOs. Last time we talked about narcissistic CEOs, how they destroy values. How is it related to your FinTech related ideas? Well, you can virtually measure the degree of narcissism of your retail investors by doing some surveys. I posted the narcissist test on your iCampus website. So download that thing and then go through the problems and questionnaires. And then answering that, you will be able to realize how much narcissistic you are. Right? Likewise, you can measure those narcissistic degree of your retail customers and predict what they can do. Splashy mergers and attention-drawing mergers the CEOs do, right? What does that imply for the retail investors? They will try to live more extravagantly and their consumptions, right, more conspicuous. Can they afford it or not, right? Or 어그로를 끄는, it's like more attention drawing in whatever way. You can leverage that information somehow and then put it into your bankruptcy prediction model for personal bankruptcy. All these kind of things, your imagination is the only limitation, okay? Now, the other part of the irrational managers. Remember here we are assuming that the shareholders or the investors are rational. The first thing we're going to talk about is home bias, right? And overconfidence and cultural difference and life experience, all these kind of things we're going to talk about. So let's go one by one. Home bias, yeah, we talked about the home bias before in the investment setting, right? Home bias and M&A of the CEOs have been studied by Schmidt and Chung and Green. CEOs are more likely to acquire the firms in the same state in which they were born and raised. If it is due to better information, right? Like acquiring a target company, potential target company. Let's say you are from Texas and then you are working in New York City right now as a CEO, right? And then there are a lot of target companies that you can acquire. Some of them may be from Texas and others may be from Minnesota or from California, all different places, all different states. But the thing is, you are more likely to acquire Texas-based companies if you are born in Texas. Okay? Why is that the case? Ambiguity aversion is there, right? Behavioral explanation is there, and then economic explanation is also there. Behavioral explanation is just a familiarity bias. Whatever you're familiar with. Oh, Texan Lone Star Company. Yeah, let's go. 우리가 남이가 kind of, that's Korean way of saying it, right? If that is the case, you will be screwing up your shareholders, right? Because there's no guarantee that you will be having a better information or whatsoever in your advantage, but you're just taking over, choosing, you are just preferring simply because it is your hometown's company, okay? Value destroying. On the other hand, if it is based on your economic information, let's say you are from Texas and then you have a lot of social network over there, and then you have better access to information, key information about the target companies inside Texas rather than the companies in California or Minnesota, all right? Due to that information advantage, if you want to go, if it is because of that informational advantage that you prefer the Texan companies to take over, then it has a go. It has a positive. It must be adding value to your shareholders. So the prediction is, if it is information economics based, right, explanation, then such an acquisitions will have positive stock price response as you announce that you're going to take over the companies in your same hometown. On the other hand, if behavioral explanation is really the reason why, then the shareholders' response will be negative on the day of the announcement, right? So positive versus negative on the day of the M&A announcement. And then they ran a regression about it, and then they found it is negative predominantly, which suggests that the takeover of your company from the same hometown, it's not adding value. It's not because of your informational advantage. That's what they infer from their results. Okay? M&A facts, yeah, talking about mergers and acquisitions. Basic fact is that is a huge market in the United States and internationally in Europe as well. And then the scale is huge. During the last 2 decades, $3.4 trillion were spent on mergers and acquisition. And then 12,000 mergers were there in the United States. Much more flexible and liquid market is there. Okay, target returns are positive because you have to, as an acquirer, you have to pay premium to the target. Otherwise, the shareholders of the target company will not surrender their stocks to you. So you have to pay some premiums. 웃돈 얹어주고 kind of. Acquirer returns are negative. Of course. Why? Because of the winner's curse. Because those premium may be excessive sometimes. You saw that in the what is that? The bidding process. Bidding for $20 bill, okay, on a table. Like competitors are there. This is clearly $20 that you see on a piece of paper, right? That's a $20 bill. How much would you pay for this? And then the people go on like forever, like 20, 21, 27, 27, 27 go once, twice. Why would you try to pay more than $20 for, the $20 bill itself? $7 more premium. That's crazy. Why? Not to lose out, right? It's such a shame to me personally. My ego hurts. Well, that's narcissism. And also, I believe, okay, that's a narcissism. It's hurting CEO's ego, right? That's narcissism. But if the CEO says, or they believe that, not it's a shame on his name, but because they believe they can generate a better synergy. Okay, they're sure to deliver great shareholder values after acquiring and after paying such a high premium, right? I'm sure that I can add to this the synergy to this M&A. Then you are more likely to be overconfident. That's the distinction, you see it, right? Okay, so it's going to be on the exam, by the way. Target returns are, acquirer returns are negative. Acquiring shareholders lose $220 billion over the same period. And why do managers acquire if this is on average losing money? Is a valid question. And then behavioral economists find out largely it is due to overconfidence of the CEO. There comes Richard Roll, big shot guy in Caltech. Used to be in UCLA. If he wins a Nobel Prize in the future, I would not be surprised. I once had dinner with him in Singapore before when he was on the seminar. It was very fun, and then he was very personable guy to just advising all kinds of things to you guys. I mean, me and then everybody. Anyway, Richard Roll has a paper about CEO's hubris, 오만함, right? It's like a 근자감, right? 근자감, 근거 없는 자신감, groundless confidence in yourself, right? Now, he says that an irrational manager, okay, versus rational market theory, right? The main idea is that acquisitions done by bidders who most overvalue synergies. They are the overconfident or optimistic in valuing those valuation of combination, and then they ignore the winner's curse, right? So I am sure that I can deliver such a huge synergy after acquiring it. Don't worry, 내가 제일 잘 나가. That's the story over here. 21, yes. And then overconfidence that you see the cow over there. We call it holy cow, right? You don't want to stuck like that in your company management, right? Overconfidence is an deepest enemy to you. Overconfidence of CFOs is also prevalent. There is a survey, I told you about it before, CFO survey research has been done by Graham and Harvey before. And then they also asked this, how would you rate your ability to pick which investment projects will be profitable for you, your firm, right? And then absolute majority of them said above average, right? I'm above average than my peer groups over here that you're in your sample. But somebody has to be below average, right? By definition, or median, right? It has to be half and half. If it is average, it has to be roughly half and half. But too much disproportionately more people believe that they are better than average in delivering shareholder values. Same thing holds true when you ask any people, are you better than average drivers or not? And then predominantly they will say, I'm better than the average, right? Especially for the guys, right, and girls. Anyway, top managers are overconfident. Overconfident by why? But why? Okay? Shareholders want the CEOs to be somewhat overconfident than perfectly rational. Okay? Why? Why? And of course, let me finish this one first. Shareholders, right? The leaders, by the way, leaders. You want your leaders to be more overconfident than less confident or underconfident, or should we say diffident. Okay? Lack of confidence, the first reason to be fired. I'm nobody. Get out of here, man. Right? It's like K-pop audition kind of things. You don't want to see anybody like lack of confidence, right? I'm nobody, nobody but you. And then you have to be fired, okay? Why is that the case? That's important. That's important. Why don't the shareholders want perfectly rational CEOs like a robot and perfectly knows and behaves that he or she is one of the many guys? I'm just an average guy. Okay? Why? Okay? Number one reason, it's because it's cheaper to motivate and incentivize the overconfident guys to do something about it. Now here's the story. Okay? Life is about the chain of decision making under uncertainty, and the decision is about risk taking. Okay, life is an endless chain of not endless. It's a chain of decision making, right? Risk taking is about risk taking, and then for the CEO position, it is choosing or decision making to take risk for the whole company. The stake of the company is huge. Okay, whether you go for a project or not is very risky. If you hit the jackpot, the whole company makes a huge ton of money like Apple or Tesla. If you don't, there's an equal chance or even worse chance that you will end up nowhere, nothing. Okay? Company may hit bankrupt or go nowhere and lose competitions. Okay? Then it's very scary for the CEOs, right? Why? Because not only the whole company is going up or down, okay, you will be responsible for that, and also your whole human capital is tied up onto that company. And number two, and your financial asset, almost 100% of your money is stuck on your company's equity, okay, because you have a lot of ownership, okay, with the governance mechanism, right? The shareholders want to align the interest of theirs and yours, right? Your objective as a CEO is maximize your utility, whereas the objective is to maximize their shareholder values, right? To align this interest, right? To solve the agency problem, they give you the stock ownership. Okay? The thing is, the stock ownership and options, right? It ties you to the company asset even more. Okay? But take a step back and think about what you learned in basic financial management. It's about portfolio management. Diversify your financial asset. Don't put all your eggs in one basket. But having such a stock option means that you are putting all your eggs in one basket. So if you are complete rational guys, what would you do? Well, sell off your stock option as soon as possible, right? Or ownership as soon as possible, and purchase S&P 500 or diversify your portfolio. Or even some people may hedge your bet so that they will buy their competitor's stock. So that your company goes down, your competitor goes up, your financial asset goes up, even though your career sucks. That may happen. Oh, that's unethical. Who can do that? Well, that's devisable at least, right? That's rational behavior. Whether you call it ethical or unethical, I don't care. It's rational. And then if you're perfectly rational, you precisely assess those risks, and then what would you say? I'm so scared. Pay me more, right? Oh, if you're gonna pay me $100 million to be in a CEO position, I think I need $200 million, not $100 million. I am rational. I precisely assess that risk, and I don't want to ruin my career. You know what? Okay? So for rational guys, to incentivize the rational guys to take equal amount of risk, we need to pay him or her a very, very high amount. It's very expensive to hire rational CEOs to do the same risk-taking job. On the other hand, overconfident CEOs, they are well motivated already. Okay, their assessment about the risk is very minimal. Okay, and then they say what? Don't worry, we're gonna do it. Yeah, let's go. I can, we can perform it together. It's not narcissism, okay? We can do it together. And I assess that risk to be, it's manageable. Don't worry, we can go ahead and do it. So that you can incentivize this guy, very courageous guy, without that much of a compensation. It's cheaper to motivate, okay? 싼 맛에, in a skeptical manner, but let's have some more dignity than that. Okay, because I am one of the overconfident guys. So overconfident guys are more welcomed for that the leadership position. Okay, so you want some guys to be more overconfident than not, but not to the extreme degree. Why? If you are extremely overconfident, all kinds of bad things happen. That excessively overconfident guys may take excessively risky projects, crazy, so that the whole company will go down. Okay, the shareholders get killed, right? You don't want that to happen either. So you want to strike a balance between underconfident versus excessive overconfident. We want some kind of a middle ground. 만사중용이 제일이니라. It's like a Confucius message by, this is SKKU, Asia's oldest university, established on the value of Confucianism and Confucius, right? We celebrate their birthday in every September, right? And this is exactly where this Confucius gets in over there, okay? When his student was asking, what is in, right? What is in? 인이란 무엇입니까? To a certain pupils, right? Certain students, he said, in is about being courageous. Why? Why? Because the listener was too much rational, too much scary, right? There are some people who have a encyclopedic knowledge about the death. Oh, so much so that when you talk about walking on the streets, he or she will come up and say, oh, you know what? I know some people who got killed when he was or walking on the street because of the land was going down all of a sudden. And whenever you talk about swimming, and the guy will say, you know what? I know some people who died when they were swimming because of a heart attack. Of course, there are some people who get killed every minute, right? But you don't need to remember all that kind of encyclopedic knowledge about death or scary situations. You need some reasonable degree of courage in it, okay? But not to the extreme. 만사중용이 제일이니라, right? So this is the reason why I ask you overconfidence related questions in your final exam. This is 성균관 University, right? The virtue of Asia is very connected to this overconfidence issue. Middle ground level of overconfidence. That's what we mean, what we need. Now I want to be humble guy. Confucianism is about being polite and then very, very reserved and not speak up. No, that's this one. Confucius never told about that. He said you have to speak up. You have to have that courage in you. Okay, wake up. Okay, you are not being Asian by shutting your mouth up. You're just shutting your mouth up. Asians, if you go to China, and they are more outspoken, right? And you and me, like never, they don't bow down, right? Like person to person, we're the same human being. Why do I have to bow like this, right? That's the same thing over here. Reasonable overconfidence. We want you to be overconfident. Okay? Don't say you're humble or whatever. You're just faking away. Anyway. Cheaper to motivate. Yes, doctrine of the mean. 가성비, right? The CEO job is a risky position, so much money at stake, so scary. If your CEO is perfectly rational, he or she would demand so much compensation to secure his or her job from negative outcomes. If a CEO is overconfident, then he or she would take the same risk, but not demand much compensation, because he is confident, all right? Sure to deliver good results out of the same dollar amount of compensation. So why not we hire him? It's better, right? If a CEO is extremely overconfident, he or she would drive the firm to be too risky. Fired, you're fired, right? Will happen. Then, shareholders want the CEOs to be somewhat overconfident. Not just the CEO versus shareholder setting, but every setting of our lives, we see these kind of things. When you meet your potential significant others, right? 여자친구 or boyfriend or girlfriends, right? Who will, you want somebody to be reasonably overconfident, then diffident or perfectly rational. Okay, you don't want anybody to be like diffident guys to be your spouse at all, right? At the same time, you don't want it to be excessively confident. 재수없어 kind of things. Like I don't like that. But reasonable confidence is what you need. Like this song, singer like 오빠 한번 믿어봐 너만 사랑하리라. Of course, right? This kind of confidence, not trust me, right? It's more attractive and sexy. That's what we, want. Biological, the evolution happened in such a way that we want some guys to be more overconfident, regardless of being male or female. We want some people to be more confident than not, right? That's it. Basically it. Remember this throughout your life, okay? And so many people of you guys, right, hide into CPA preparation and say what? I'm a humble guy and I know precisely about me what the limitation of myself, so that I have to take the preparation to take the exam, and I need a certificate. If I don't hold a certificate, I'm not confident enough to go into the job market. No, come on. You're better than that. Your lack of confidence itself deprives you of job opportunity, not the lack of license, but the lack of confidence deprives you of the job opportunity. Remember that, all right? Yeah, I should stop over here. Wizard, right? Many management apparently were overexposed to impressionable childhood years, to the story in which the imprisoned handsome princes, and you read the story by the Warren Buffett, right? So many overconfident CEOs are there, so much so that they, pick up all random target companies and believe that they will make a value-adding mergers, which turns out to be value destroying, and then the CEOs get kicked out because of the overconfidence. Synergy my eyes, okay? And then Malman DA and Tate are the ones who developed this whole literature about the CEO's overconfidence, right? And Malman DA is a big shot in the UC Berkeley, and then at one point she, invited me for the AFA conference presentation for my paper that I'm going to talk about later. She's a great one. And then overconfidence M&A, yes, Malman DA and Tate, 2008 paper. They start by measuring overconfidence. The breakthrough, okay, of their paper was about how to measure this overconfidence. 자신감, how? It's there. We can predict that, right? Theoretically and mathematically, we can model it somehow, okay? But empirically, how can we test, how can we measure that degree of overconfidence was a big challenge. And then their clever idea was about when it comes to CEO setting, they have call option, right? They have call option, which is about, their right to exercise, to buy their company's stock at the cheaper price, the strike price versus current market price, right? As long as your current market price is higher than the strike price, you can exercise it and then buy your stock cheaply and then turn around and sell your company stock at the market price, which is higher than your purchase price. You make money. Kachang, kachang. Right, that's a call option. But the idea over here is if you look at the CEOs, thousands of CEOs cross section, then there are many CEOs at the end of their fiscal year, their call option position is deep in the money, yet they don't exercise that option. Kachang, kachang, no way out yet. But keep the option as it is. Why? It's not European call option, but it's more like American call option, so that you have vesting period of like 3 years to 5 years down the road. Okay, so this is your option. Okay, your option contract starts at day 0. After year 3, maybe the option starts to get vested, which means you can exercise from now on. Vest. Why is it vested? It's like a bullet, gunfighting bullet. You have a vest, and your bullet is full over there, and then you can exercise it. That's vested period. The vested period starts from 3 years all the way down to maybe 8th year. Okay? So as long as this is the strike price, okay, strike price, starting from here, as long as your stock is in the money like this, if you are rational CEOs, you have every reason to exercise this option because your financial asset is all put in one basket called your company. You want to diversify away. So you want to cash it out right away, immediately. Okay? So that's one thing, right? Strangely, many CEOs don't exercise at this point and then wait. Okay? God knows where the stock price will go in the future, but they don't exercise at the end of year 4, 5, and then blah blah blah, and wait until the end. Why? Why? Because one of the two things. One is they are overconfident. They may believe at this point, okay, their current price is here, strike price is there, deep in the money, but if you are the CEO, overconfident CEO, what would you believe? My company value is not this, okay? True value of my company is this. So in a couple of years, it will shoot up like this. Why do I exercise it right now? I am confident. We are confident. We are great companies, right? So wait. So they don't exercise it. Wait until the end. That's overconfidence explanation about it. Number 2 possibility is what? They may have insider information, okay? That there is a sexy project coming up soon, which is not priced yet, right? In that case, they would not exercise as well and wait for this, right? But they carefully tested and rigorously tested and then found out that it is not driven really by insider information, but it's rather groundlessly waiting and then being overconfident, right? So how would you measure this? Well, you have the degree of deep in the money, right? Compared to the stock price, the strike price of K, sometimes 67% above your the strike price, you still don't exercise it. Sometimes 100%, sometimes 200, 300% in the money compared to your strike price, you still don't exercise it, right? That's way more overconfident, right? That's the degree of overconfidence they capture. Of course, you can capture degree of diffidence, which is lack of confidence. There are by what? Well, there are some CEOs who exercise their options even when the stock prices within 0 to 33% percentage in this narrow range, right? At the end of first year or second year, and then they still exercise immediately. Ka-chung! Why did you exercise it? Lack of confidence, right? They've devised this kind of option-based measure of overconfidence. That's one big contribution. And then the number two measure is about the media-based approach. More confident guys, language is a mirror of your mind, right? Noam Chomsky said it. So the CEOs who are more overconfident are more likely to say the words related to confidence or confidence word in their media interview, okay? So text analysis, you do it, and then whenever there is a CEO coming up in the news article and then there is a word related to this confidence, we identify the guy as overconfident guys, right? So that's media-based approach, okay? Right. What does this imply to your FinTech? Well, if you're Kakao Bank, right? Kakao Bank, what do you have? Everybody's Kakao message over there in your data set. Be honest, come on, right? You can analyze those texts and see how much of a confidence word they would say in their messages. Wow, that's why Kakao Bank is hugely fastly growing right now. It's a formidable threat. Okay. Now, yeah, the CEOs, right? A well-diversified investors would not exercise option early, but CEOs are not well-diversified. They should exercise early and diversify away labor income risk. Idea is that rational CEOs exercise their options well before the expiration date to minimize exposure to company-specific risk. CEOs who are long holders are therefore bullish, overconfident. Also, the tendency, frequency of words, right? Or I should say frequency of the words like this in the media interview, right? Optimistic. They measure it and find out that overconfident CEOs, right? Managers are more likely to pay cash but not stock whenever they are doing M&As, right? Mergers and acquisition, right? You are the acquirer company and you want to pay the target company shareholders either in cash or with stock, right? Stock exchange or cash, 현금 박치기 or 주식 교환. Which one would you do? For overconfident CEOs, you will believe that your true value of your company will be way higher than the current stock price. So would you ever use your shares, your company's shares, as an exchange method, right? Currency to take over a target company? Would you use your shares to pay the target shareholders? No. You will say what? Oh, this is right now deeply undervaluing our true value. I'm confident. We are confident that this company will be great, 10 times bigger. Why would I pay with this shares, right? Those target shareholders just eat up our cash and get out of here. Okay? That's what they would do precisely. And then this is what they find in the data. Out of thousands of mergers, we are not talking about 30 different mergers or 20 different mergers. We're talking about thousands of different mergers taken. Okay? Whole universe of events, right? They find it. It's obvious, right? Cash acquisition. Now, the second prediction was market reaction to merger bid announcement will be more negative for overconfident managers because their overestimated bid must be, value destroying. They are paying too much. And then drainage of cash, it's not helpful, right? You need precautionary savings in your vault somehow, in your bank account. Why do you spend and drain your cash, right? That's a secondary concern. First of all, your CEO is more likely to overestimate the true value of this synergies and after merger values, right? You're wasting your money. So that's the shareholders' response will be, ooh, right? That's what they find. I talked about the negative side of overconfident CEOs, right? But it's a double-edged sword. Okay, double-edged sword. I'm going to talk about it in the next lecture. So wait for that. Thank you.